best strategies to trade for small accounts. Trading a small account can sometimes be a little more challenging than trading a larger account because there's less capital to work with. And I've personally traded large accounts. I've traded small accounts. I've traded well over a 7-figure account. I've traded down to a $500 account, right? So I have been within the ranges, whether it was helping manage family accounts or trading my own accounts or anything like that. I've certainly been there in trading both large and small accounts. And small accounts can certainly be a little bit more challenging, it feels like, to have them grow or to at least get started, especially if you're doing something like a $500 account, because there's so little capital to work with. So you have to really be mindful of what you're putting into a trade, what your risk versus reward is. And we'll talk about all that here in a second. But this is why I'm really excited that we're going over this today, because for those of you with smaller accounts, or maybe you want to start an account for your kid, or you want to get your kid into trading. That's what my dad did with me. He wanted to get me into trading. So I first paper traded to learn how to trade before going into real money, of course, to prove that I knew what I was doing. But right, you might want to start them off with a smaller cash account and don't immediately have them trade your 401k or anything like that, right? So your retirement account. So because of that, this will be a great mini educational bit going over some of the strategies you can consider and the other things that I think you need to consider that are important when trading both any size account, but in particular small accounts as well. So like I mentioned, it doesn't mean that you cannot grow a small account into a large account, right? John actually has the small account mastery class. He grew that account quite beautifully. A while ago, I was able to take a $10,000 account and grow it into a $43,000 account. So it certainly can happen. Traders here have done it. I know traders in the room have talked about being able to grow their accounts. We've gotten emails and things like that. So it's possible, right? It might be a little intimidating, but it's possible. There are just a few things you want to keep in mind when trading. So the first thing I might be a little biased towards, because my main focus in trading is risk, but I think it's one of the most important thing, if not the most important thing, that a trader needs to consider when trading any size account, but especially a small account, right? You need to understand what your risk tolerance is. So that's the first thing that I'd ask myself is, what is my risk tolerance? And determining what your risk tolerance is the best way to understand how much you are willing to lose of your account. And personally, I also think it's a great way to keep your emotion out of trading. And I know a lot of traders would agree with me on that. To keep your emotion out of trading can sometimes be one of the most difficult things to do, whether it's FOMO, fear of missing out on a trade and trying to jump in on what's already rallying and not a good setup, or maybe staying in a trade too long because you have that hope, right? That hopium, as we like to call it, to try and figure out whether or not it will work in your favor when all the technicals are telling you to get out of the trade. And so by determining your risk tolerance, it makes it easier to keep that emotion out and allow you to stick more with the technicals in your trading plan. Now, risk tolerance can be looked at in several different ways, but the main two I would say that you should look at your risk tolerance for is, what is your risk tolerance on each individual trade you jump into, as well as how much of your overall account that you want to risk, right? For those of you who have taken my classes or you've been here a while, I have a 25% rule that I go by. And it just very short, the 25% rule basically means I'm not trading more than 25% of my account in new trades. So that doesn't mean all 25% goes into one trade. It's split up into multiple trades. I leave another 25% of my account for any management of a new trade that might fall behind. So yesterday we talked about defending options, right? One of those is cost averaging a trade, or maybe just closing out and putting on a new trade with a new setup. And so if I'm using that trade to help cover a loss, or if I'm cost averaging it, that goes into the management portion of my account. That goes into that 25%. And then 50% of my account, I try to leave completely untouched. This way, if, God forbid, knock on wood, I lost all of my new trades, I lost all of the management side of my trades, I still have 50% of my account left over to take a step back, kind of take a look at my trading plan, understand what I did right, what maybe I did wrong. Maybe I was in too many lotto trades, or, I kept getting into signals that had already technically fired. I was getting in too late to some of them, but I can take a step back, see what I did, maybe paper trade some more, build up that confidence again, and then use that remaining 50% to then once again apply the 25% rule to, but work my way back up to the original account amount. And also, but for those of you who are looking at keeping trading as more your profession, the other reason why I like to keep 50% of my account untouched is, let's say I have a bad week or a bad month, but I still have bills to pay, or maybe the car got a flat tire, so I need to take care of that. Well, by leaving 50% of my account untouched, I'm still able to pay myself, right? So if I'm having a bad month or something like that, I'm still able to take from the account and pay myself and know I still have plenty of capital left over to trade with. And so if you're looking at it as being more of your full-time job, I think that is definitely key when you're trading cash accounts and things like that, to not only pay yourself on profits, but leave some of your account untouched. So that way, if you run into an issue, you can still pay yourself. And a great metaphor for this is, imagine you have a towing company or you have a construction company, right? And you have a truck out there, and all of a sudden your truck gets a flat tire. Well, that's an expense cost, right? It's going to eat into your profits, but it's something to expect, right? Truck tires aren't going to always be beautifully inflated with great tread, right? They're going to need replacement, or, accidents can sometimes happen to where you need to cover them, or unexpected events. And so in trading, it's, you sometimes forget to look at losses, or, a quick downturn when maybe bullish like we've seen recently. You kind of sometimes forget to remind yourself of that, and you kind of beat yourself up a bit more and get more emotional or mad at yourself. But if you first stay within your risk tolerance of your own account, both with the individual trades in your main account, then you don't find that emotion there as much whenever those events do occur. And it's also keeping some of that protection back there so that you can still pay yourself and still have some money to live off of if this is what you're looking at to make your full-time job. So that's the key to trading any size account, let alone a small account, right? Is, what is your risk tolerance? Now, maybe it's a cash account where you're willing to lose 100% of it. So then that percentage of my 25% rule might work out a little bit differently, right? Maybe 50% into new trades, 50% management, because you don't mind losing the whole thing. But if you're looking to use that as your account to pay yourself with, I would certainly leave at least some of it untouched in order to do that. So once you understand your risk tolerance, you can then determine the strategies you may want to trade. Long calls and puts are a great way to grow an account quickly because it has that unlimited profit potentials. But you may need to find symbols with a smaller underlying asset price to stay within your risk tolerance for your account. So an example, just recently, right, there's Kroger, KR, there's JD, there's Work. All of these currently have longs out at least 30 days. And for myself, I typically like to look at least 30 days out for a long call or put. So that's why, I kind of put that in there. But all of those have long calls, long puts, at least 30 days out, that can cost anywhere between $2 to $5 for strikes in the money, right? And that's $2 to $5 per contract. So if you're looking at a one contract trade, that's a $200 to $500 risk tolerance. That's rather small overall when we're looking in regards to a long call and long put. So if you have an $1,000 account, let's say, and you're only risking half of it, then a long call that's worth around $2 would stay within your risk tolerance on one contract, and you still have some capital actually to consider maybe another trade, another sector, to trade a symbol in with a different setup on a different chart, right? So you can have symbols out there and still be able to take things like long calls and long puts. And as I mentioned, they allow for an unlimited profit potential, but they can also start to become expensive, especially when you're trading larger symbols like Amazon and Netflix. So there are pros and cons to trading assets with smaller symbols. Sometimes it means there's less volume, there's less open interest there. So you're having to get filled closer to the bid and ask. So keep that in mind as well. But there are also benefits to it, to where if you do all of a sudden get one of those nice spikes to the upside, it can allow you a pretty nice profit still on a rather small risk. And you can see your account really start to grow at that point. But let's say you have that set up, right? And you want to take a trade on Amazon or Netflix. It looks great. You like the liquidity, but you can't just be paying all that money. So when long calls and puts cost too much to trade, this is where vertical spreads can come in handy. I'd say this is the next best strategy to trade in small accounts. Whether it's debit spreads or credit spreads, this can be a great way to still take advantage of that directional move without having to risk as much capital. So in Netflix, for example, you can jump into a long call around $30, right? Especially with how the volatility added some extrinsic value, they're a bit more expensive now. So around $30. So let's say my account's only $1,000 though. That makes no sense. I wouldn't be able to jump into that trade. But a 10-point long debit vertical spread, let's say, is only $3.50 per contract. So instead of paying $3,000, $30 cost basis based on one contract is $3,000. So instead of paying $3,000, I'm now only looking at a $350 cost basis for each contract I get into. So it greatly reduces my risk, but still allows me to play a directional move to the upside. So it still allows me that benefit to take advantage of the signal, but for Lee, when I mean a 10-point long debit spread, it's a 10-point width. So for example, let me just pull up Netflix here. Yep, that's not Netflix. There we go. So Netflix, let's say we like this to the upside. You guys know on a longer time frame, I certainly like this up into 400. But let's say we're getting a really great signal on Netflix and it looks like it's going to get up there within the next week or so. So to jump into a long call, which usually, like I recommend, still 30 days out because it protects against theta decay. So even if we think the move will happen within the next week, to protect myself against theta decay and maybe to allow myself to play the move a little bit longer, I'd go out at least 30 days. So May 8th to May monthly. May monthly is going to have that open interest. And you can see here, right, just getting at a 0.7 delta right now is about $44. So it's rather expensive. Even, just getting closer to at the money is still around that $30 cost basis, like I mentioned. So instead of doing that, and we still think it's going to get up to 400, we could consider going out to April and looking at something like a 10-point long debit vertical spread. So 375 is my first strike, 385 is my second strike, and we can see here that there is 10 points width between that. So that's what I mean. Exactly, Spaz, yeah. So 10-point width between the strikes, so $10. So let's just get slightly closer to that cost basis I was looking at, right? So the 380, 390 has around that 325 cost basis. Let's say it was 350 that we paid, just to keep with the example on the PowerPoint slides. We can see here the max profit potential is 650, right? So it still allows for that directional move to the upside. Our target's 400, so it still allows a move up into 400, but it does it on a lot less capital, right? Overall, so $350 risk per contract versus a $3,000 risk. Now, the con to this, right, is that it limits the profit potential. So we kind of just talked about that. So instead of an unlimited profit potential on long calls and puts, right, where if the price just keeps going higher, you're going to still be making money on them as long as there's time on the trade. On this long debit vertical spread, it is a limited profit potential. You can only make so much on the trade because it's a vertical spread rather than a long. And because we have the short strike helping offset the long strike. So the 10-point width minus the 350 in the case of a long debit call vertical spread means we have that 650 max profit potential. Still an excellent profit to receive, right? I would love to get 650 and walk away with that even on a long call. Still wouldn't be a bad profit to take. But in this case, we're doing so on a lot less capital risk overall to see that profit occur. So that's one way you can consider trading a small account is using vertical spreads like credit spreads or debit spreads to still be able to take it in a directional move without having to maybe pay that $30 cost basis to jump into a trade that's a little bit more expensive on the underlying asset and option strikes in general. To build off of vertical spreads, Iron Condors and Butterflies can also be a great way to trade small accounts, right? So Iron Condors, a build up of vertical credit spreads being combined. Butterflies, standard ones, of course, are a build up of long debit vertical spread and a credit spread combined, sharing that same short strike. Certainly, go back and watch those videos. We've discussed both of those trades already. But Iron Condors and Butterflies can also be a great way to trade small accounts. This is because they typically allow for a low risk, high reward trade. These can be great for more consolidating charts, like Iron Condors, for example, are great in choppier markets, or for trades where you have a target in mind with the underlying asset price. Keep in mind, you still need a chart setup in order to put on the appropriate strategy, right? So, and we'll talk about this later this week, but for me, the chart always comes first before just throwing out a trade, right? Because if you're not looking at a chart, if you're just throwing out a trade out there, hoping it works, oftentimes it won't, right? Because maybe it will, but you have no idea off the technical. So for me, the technical always comes first. And then that way you actually know what strategy might work best for that chart. So you still need the chart set up to put on the appropriate strategy, but these are some great ways to take trades and still allow that profit. So once again, back to Netflix, right? We kind of talked about how I like 400 as an overall target to the upside. So butterflies can make great for potential target style trades. So let's say we think it's going to get up to 400 by next week. I'm not sure if this is the case, guys. This is just for an example right now, right? So not a trade I would take. But if we think it's going to get up to 400 by next week, we could look at a butterfly pin around 400. Let's say we wanted to do a 20-point butterfly. So 380, 420 as the wings, $4 cost basis. We're looking at a 375 cost basis. So very similar cost basis to our debit spread. But in the case of a butterfly, right, we talked about how it allows for an excellent low risk, high reward trade. Well, on this butterfly, we can see the risk is rather low, and that profit potential, instead of being $6.50, is $16.20 in this case. So excellent risk versus reward. Now, once again, go back and review the butterfly strategy if you haven't done so already to understand, what the underlying price symbol needs to do, what Netflix needs to do here in order for you to allow for an overall profit. So please go back and review that. But you can see here, butterflies would be another great way to trade a small account and still allow for an excellent profit potential to be able to grow it. So those are the slides that we have. Let's go ahead and pull up the daily chart here. And we can talk about some real-time charts here and talk about some examples we might put on for a smaller account. Gerald, you can certainly go into legging into a butterfly, if that's what you're referring to, by starting off with a spread, and then if it looks like it's not going to get up to that level or it's starting to fall a little flat, you want to protect risk by putting on, for example, the credit spread to turn it into a butterfly. You can do that, but you can also just start off a butterfly just as is. And personally, if I were to do something like that, let's say on SPX, that's exactly what I would do versus a vertical spread. Because you can really get some hits on SPX on those butterflies, whereas if you're starting with a vertical, it's still going to cost you quite a bit of money. So let's pull up SPX really quickly. Right now, we're making a bearish divergent bar for today. We're selling off. We're breaking back below 2,700. 2674 on the daily chart is my next target. certainly if we break below that, 2,600 is going to be another good target to the downside, followed by the lows here around 2,450. So 2,600, I think, could be a good target for the end of this week if we do end up kind of staying around this range. Let me pull up Thursday's expiration, which is the 9th. Keep in mind, it is a holiday week this week with Good Friday. So that means, of course, that there is no Friday trading day, and Friday's expiration is pushed up to Thursday. So, not much time left on this trade, but let's say I want to pin around 2,600. So first, and I want it to be a 50-point spread, right? We've seen a volatile market. We know the ranges that SPX has been producing recently. Today's range, for example, is already $66.22, and it's, barely it's not even 2 hours into market, right? So because of that, I want to be mindful of that, and I want to be able to try and get a really wide width butterfly here. So if I start with the 2,650, 2,600 long debit vertical spread, I'm looking at about a $13 cost basis. If I have an account that's only $1,000, that's not going to work on my risk versus reward scenario at all. That's more than the capital I have in my account, right? But I really want to take advantage of a potential pin down here, right? Because let's say we're seeing a lot of signals that say we're really going to move down to 2,600 and stall there. So I really want to take advantage of this. So instead of starting off with the debit spread, I can start off with the butterfly itself and add on the extra contract here to create the credit spread, the 2,600, 2,550 credit spread, and turn this into a butterfly. Now my cost basis is only around $5. So instead of around $13, which I wouldn't even be able to take the trade at that point in a $1,000 account, now I would be able to. For myself, I don't know if I'd want to spend $5 personally. If I only had $1,000, I'd probably narrow the spread a little bit to try and get a better risk versus reward. So something like a 35-point spread, 235. That makes much more sense to me in a $1,000 account on my risk. Well, my personal risk tolerance would be, right? But you can see how much more dramatically that cuts away versus something like the long debit vertical spread where it's 840, right? Where that would be the majority of my account just in one trade. So, if you have a larger account, let's say you have a $10,000 account, right? And that's your smaller account that you're working with. I'd say anything under 10,000 is a bit more of a smaller account. Once you start to get above 10,000, it's a bit, easier to put on those larger trades. But, if I had a $10,000 account, then I might not mind starting with something like this and then going into a butterfly. But let's say SPX takes a while to get down here. The benefit of starting with the butterfly is that the theta decay on this side of your trade is helping offset the debit spread. So if it takes a while for it to get down here and you're starting to see this, unrealized loss and it's kind of eating at your emotions, well, starting with something like a butterfly, it's going to be a lot more stable, a lot less of a loss that you're looking at. And then even if we just start to get some sort of move down to this range, sometimes you don't even need it to go all the way to your wing on a wide width butterfly like this for you to start realizing a quick profit. So certainly when I'm intraday trading and using the profit recycling strategy, I'll do things like legging into a butterfly. Absolutely. But if it's just a standard trade that I'm looking at, just to jump into, I don't mind doing the butterfly in its whole. And then is Kroger still valid? Let's pull that up. Let's pull up Kroger. So Kroger to me is still valid right now. Yesterday we made a nice bullish divergent bar. I would have anticipated a higher high at that point. That follows through within the next day, and Kroger is typically pretty good about following through within the next day on some sort of higher high, but we typically give that strategy 3 days to work out. So if you did jump into a bullish divergent bar trade yesterday, you still have time to do that. I myself jumped in prior to this week in a long call, and yesterday I debated about getting into a trade. I decided not to. I'm just holding right now because I'm in the long 30 call. And now, today, it's also, once again, it went down, tested support, held it quite nicely, bounced back up, and is making another bullish divergent bar. Now, I would be a little cautious here because back-to-back divergent bars can mean consolidation. However, I do like the fact that they're both bullish. So they're both giving clues about seeing some sort of higher high. And sometimes when you get back-to-back bullish divergent bars or back-to-back bearish, not always, but there's usually a good follow-through that the next bar or two will follow through on the higher high from this one, and certainly follow through on the higher high from this trade here. We have momentum crossing above the zero line, still bullish with room to move higher. We still have a valid bullish signal on the compound breakout tool, and we're still in a daily squeeze. The only thing I don't like here is I still want the 10-period simple to cross above the 30 to form a stacked up formation, and I would prefer the Bollinger Bands to be more like they were Friday going into Monday, where they're starting to flare open. Now they're starting to come back down, which is still a sign of consolidation, unfortunately, because they're still a little flat. However, keep in mind the price likes to trade within the second deviation, Bollinger Band, which is this inside blue line here, and there's room up to that level. That move is around 34.33, so that's easily a good $2.50 move higher from where we're trading at to still take advantage of some sort of profit if we moved up there and stalled. Of course, my longer term target would be closer to around 36.73. That's the prior highs as well as the ATR trailing stop. If you are referring more to my trade, the weekly chart still has that weekly squeeze. Still a choppy signal here on the compound breakout tool. I'd prefer that to start to turn bullish. But momentum, let me zoom back out, still has room to move higher. And though we are attempting a red bar this week, we'll have to wait and see how it closes first. But second of all, the bars are still well above the zero line. So that's overall bullish strength. The trend itself is turning bullish. The 10 and 30 have crossed above the 100. Bollinger Bands are still pointed up. So I still like Kroger to the upside. On this trade, we gave ourselves until the May monthly expiration to be able for this to work out. I'm in this trade. Let's see, it's the 30 strike. Let me take a look real quick. I'm in it for a 325 cost basis. So I do have a small drawdown. If I wanted to put more capital into this, I could certainly consider doing that here. If we close in a bullish divergent bar, I wouldn't mind doing that. But I don't know if 287 is the point that I would want to cost average this trade. Right? So let me just do it from here. 325 plus 287, if that was my fill, would mean I have a total of $612 of capital at risk now. So it, is a capital negative move to my account. I'm putting more capital into the trade, but my net debit on the trade, right, cost to average, would be 306. That's not that much of a difference from 325. If this was worth closer to maybe $2 or $1.50, then I wouldn't mind cost averaging the trade if the chart looks like this and the price was down here. But with the price being so close to my original cost basis, I think I would prefer just to hold and wait for the bounce back up. That's just my personal preference. You, of course, could do what you think is best. Instead, I think if I wanted to add more capital to this trade, so there are a few different things you can do. First of all, if you did want to jump into a long call, the 0.7 delta is technically now the 29 strike. That's a 252 cost basis here. Pretty wide bid and ask. So that might change itself, right? Because if this is 282 on the cost and this is 252, we know this one wouldn't be less than the strike here. So this is probably at least $3, if not $3.10. It's just that there's not a lot of volume in this strike today, probably. Yep. See, not a lot of volume in this strike today. And so it's kind of giving you a bit different of a mid strike. So keep that in mind if you went with 29. Personally, I would still probably stick with the 30 strike because you can see the bid and ask is a lot more narrow. So this is a lot more likely the price that you will get filled at around the midpoint. And there's a lot more open interest at the strike. So the liquidity of jumping in and out would make sense. So as you can see here for Kroger, just one contract of this currently is a $273 cost basis. So for a small account, with a long call like this makes total sense, right? It's a small portion of probably what your account size is. If it's $1,000 account, it's a little bit over 25% of it, 27% of it. So it's a lot smaller, still leaving you capital to, pay yourself with if you needed to, and still leaving you capital for managing a trade or maybe jumping into a new one, depending on how you allocate it accordingly. But let's say you wanted to do more of the divergent bar trade here. Well, yesterday, I still wouldn't mind going with a this week expiration. And if you don't mind the capital risk, you could still potentially go with a this week expiration if you wanted to. In this case, let's see, the high of yesterday was 32.76. The high of today is 32. So for a bullish divergent bar trade, typically, right, I give it 3 bars for it to work out. So on the daily chart, 3 days. And I'm looking for some sort of higher high compared to the bar that printed the bullish divergent bar. So in this case, I'd probably look at something like this, the 31.32 long debit call vertical spread. You can see it's only 50 cents, right? So 50-cent risk versus a 50-cent reward. So even risk versus reward. And of course, on one contract, that's just $50. So definitely you can do this in a smaller account. You could even build up your contract amount some. So if you did 5 contracts, that's a $250 risk, $250 profit potential. And when you build up the contracts like this, let's say you only took a 20-cent profit on the trade. You closed out of it at a 70-cent net credit, and just locked in the profit that you saw. Well, if that's the case, 20 cents on 5 contracts still allows for $100 profit potential to be locked in. So Kroger is a great way to trade a smaller account, certainly, because we have the setup here. And depending on what you want it to do, whether it's the longer term setup based off of the daily and weekly squeeze, and you want to jump into a long call, or if it's the shorter setup here using the overnight profit strategy, where you're just looking for some sort of higher high, you could certainly do that. If you wanted to be a little bit more conservative for the overnight profit strategy, I'd go to the next week's expiration. Still look at a similar situation, right? The 31.32 or maybe the 31.33 strike. That's about a 70. I'll just jump in around a bit. I'd say 80-cent cost basis, roughly, right? Let's just say it's 80 cents that we got filled at. So that's $1.20 profit potential versus an 80-cent risk. And once again, you could build up the contract amount, right? Let's say we still wanted to keep around a $250 risk capital-wise. So 3 contracts is a $240 risk, $360 profit potential. And then once again, let's say we got filled at, a 50-cent profit. So we closed out of this at $1.30, right? Which still leaves plenty of profit on the table, but we close out of it for 50 cents. That's still going to be then $150 profit based on 3 contracts. So as you can see here, vertical spreads can still allow for a great way to make a profit, even if you didn't want to do something like the long call.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency.
It's one of the things that won me.